When I was a child, I used to play chess with my grandfather, and my favorite strategy was to mimic his moves. I enjoyed watching my grandpa take a lot of time in deciding his next move, and on the other hand, I just copied what he did earlier. Many a times, this strategy worked for a long part of the game. However, in the end, I had to come up with my own ideas, otherwise I would have lost the game. Point was that I was always a step behind, and if you want to win, you have to think ahead instead of clinching to the back. The same is applicable to the share market. So what is copycat investing? Copycat investing is simply tracking the investments of the big players in the market and replicating their buys and sells. These big players have already proved their expertise in the market in the past, and hence it makes sense to keep an eye on their investments. This type of investing is also called sidecar investing or coattailing investing. So how do you track the buying and selling of these ace investors? There are a number of ways by which a regular investor can track the buying and selling of these ace investors of the market for copycat investing. Let's look at a few of the easiest ways. Number 1, company disclosure. Each company has to disclose the names of all the investors who hold more than 1% stake of the company. You can read these reports to find the names of the big investors, if any. Number 2, block or bulk deal. You can find the details about the investors involved in block deals and bulk deals on the stock exchange websites. These details are published every day. You can read. Number 3, monthly portfolio disclosures of equity funds. These equity funds release their monthly portfolios, as most of their funds are managed by ace investors. You can track their portfolio from these monthly disclosures. Number 4, investment blog/news channels. There are a number of investment blogs who track the investments of their favorite investors. You can subscribe to these sites. Moreover, many a times the news channels and financial websites also highlight the top picks of the big investors in the market. Number 5, social media. Sharing information of the newest investment is not new to social media. You can follow these big players' social profiles on Twitter, where many a times these players can release their latest picks. So does copycat investing actually work? There are a number of regular investors who claim to make huge fortunes by copycat investing. As a matter of fact, theoretically, this type of investing should work. However, if you keep copying the portfolio of these big players, you won't be able to keep winning for the long term. We are going to discuss why copycat investing fails most of the time now. Here are a few reasons why copycat investing is not a good strategy. Number 1, you both don't have the same financial situation. The big investors can easily remain invested in that stock for a long period of time, let's say 5 to 10 years. On the other hand, you might need to raise funds in a hurry sometimes, and this might cause you to exit early from stocks. In such a situation, you might book heavy losses. Number 2, an expert has a diversified portfolio. While trying to copy the stocks of the ace investors, you need to understand that those big investors have an already diversified portfolio. For example, let's say that Rakesh Jhunjhunwala has 20 stocks in his portfolio. His portfolio is well diverse and the risk is mitigated. On the other hand, you buy just one stock on which Rakesh Jhunjhunwala has invested in recently, your risk level won't be the same as that of Mr. Jhunjhunwala. You will have a high risk situation. In such scenarios, it's better to copy the entire portfolio. Copying one stock from Rakesh Jhunjhunwala's portfolio and another from Dolly Khanna won't help you diversify. Number 3, not knowing the whys of investment. If you do not know the reason why you have invested in that stock, then you will not believe in the company for the long term. In such scenarios, if the company doesn't perform well soon enough, you might lose faith in your investment and exit early from the stock. Number 4, keeping tabs on their investments is tough. One busy week and you might never know when these big investors left that stock. It's difficult to precisely copy the actions of these investors. Most of the big players in the market are full-time investors or fund managers. A regular investor with a 9-to-5 job does not have so much flexibility to remain actively involved throughout the market hours. Number 5, you don't know their exit strategy. You may copy the portfolio of these big investors, but how are you going to understand their exit strategy? Maybe they plan to remain invested for the next 10 years and your investment goal is just for 2 or 3 years. or maybe they are planning to exit after booking a small profit of 50 to 60% as they do not believe in the stock long term. But you bought the stock from a long term perspective. How will you understand these? It's foolish to enter a stock without having an exit strategy. Number 6, delayed information. While copycat investing, it is really important to know that the entry and exit points of these ace investors can be delayed. Any delay can be a decider for their returns. You might know that the big investors have invested in that stock, but if you do not know the entry price and are willing to enter at twice the price that they have entered in, then the delayed investment can greatly affect the overall returns. Number 7. Big ace investors can make mistakes. The big investors are also human and are capable of making mistakes. However, they can afford the losses as they have planned everything out. You might not be able to afford the losses. Overall, theoretically, it sounds like a good idea to mimic the portfolio of big investors in the share market. However, in practicality, copycat investing is tough. A retail investor cannot match the resources, opportunities, and flexibilities available to these big investors. The best you can do is keep an eye on the investment of these ace investors and then make your own investment strategy for that stock. Tracking stocks is a good idea. However, not doing your homework before investing can definitely hurt your portfolio. We hope that this video on copycat investing has helped you. Happy investing!